There's serious movement in global bond markets, and it matters far beyond Wall Street. With real yields surging in the US and Japan's bond market also under pressure, the implications are being felt in mortgages, corporate debt, and asset valuations globally. Joining me now is David Scott. It's good to have you with us on the program. What are we seeing right now with the US yield curve, just to start?
G'day, great to be back, Mike. Yes, some pretty alarming moves, I've got to say, when it comes to the yield curve, especially what you call the back end of the curve. And we're talking about maturities of 10 years and longer. We've seen a really big increase coming through in those particular tenors, not only in the US, but in Japan and other major economies as well. And that's problematic because it feeds into so many things that we deal with in life, whether it's talking about other broader asset classes or what we deal with as people in the actual economy.
Yeah, 100%. So why is this not an inflation story? What are real yields and why are they surging?
Yeah, so real yields, basically, the way that markets go and look at this is that you've got inflation expectations, and then what real yields do is they strip out that from what nominal yields are, which you go and see on the news each night and the like. And it gives you a sense as to what the term premium is to go and hold debt for a certain maturity. And so there's not been any real meaningful increase coming through in inflationary pressures, at least in those metrics. So it's been driven by other factors. It could be expectations for better growth, but in this instance, I suspect it's more insurance being demanded by buyers to go and buy the debt at these levels because there's so much concern, in particular, about the US fiscal position.
What's driving the sell-off in the US Treasury market?
So we're talking about the big, beautiful tax bill in the United States at the moment. Of course, there's already concerns out there. Moody's on last Friday went and downgraded the US sovereign credit rating from the top-notch AAA to AA1. And all these confluence of factors are moving in here, and it's really making people concerned about the trajectory for US debt. They're already running deficits totaling $2 trillion plus, over 6% of GDP. And then they're talking about putting a bill through, which is going to add to spending, potentially adding another percentage point per annum to that fiscal deficit. And so when you put those factors together, people are saying, well, hang on, if you're going to be running these massive deficits, who's going to go and fund them at really, really low ultra rates? And the market right now is stepping back. The bond market is saying, well, at this point in time, we're not going to go and step in aggressively until we see signs of confidence that you're going to go and address those fiscal issues.
Okay, so why should everyday Australians care about what's happening in the US and Japanese bond markets? This is an interesting one.
Yeah, because this is where the rubber hits the road, and this is why people should care about it. So there's a couple of different factors. We're talking about the US Treasury market and the Japanese government bond market. Combine those together, it's worth about 40 trillion US dollars. So that's with a T and in US dollar terms. So a lot of money. And that sets the cost of money elsewhere in the world. It doesn't mean that everywhere across moves in unilateral terms, but it means that the borrowing cost for Australians as well, when it comes to longer dated money in particular, becomes much more expensive. That goes into feeding into mortgage rates, feeds into credit card rates, feeds into financing of debt when it comes to corporates as well. And so that's why you should care from that perspective. And then when it comes to your wealth, your retirement and your investment portfolio, we're talking about the ultimate risk-free rate. So everything is trades off a spread of these particular yields. And when you see them starting to go ratchet higher, you have to go and look at valuations in other markets and say to yourself, should it be valued this high if we can go and get 5% for 30 years in a US Treasury yield? And that's where it's concerning because we have so many asset classes around the world right now that are very, very expensive.
Yeah, okay. So how do these risk-free rates influence mortgages, business loans and investing more broadly speaking?
Well, essentially, you've got the US government, and the government's trying to go and finance its deficit, and it's saying, well, okay, we can go and get the central bank, the Federal Reserve, to go and print and go and pay back. So we don't have to worry from a credit perspective on that side of the equation. But if they're having to go and pay 5% for 30-year money, what's a household going to have to go and pay? Because they're going to be inherently deemed to be more risky. What's a corporate going to have to go and pay? And that's where it becomes problematic because we're talking about even higher yields. And then that flows through to the economy. You can't go and have economic growth without really decent supply of credit and credit at reasonable rates. And when it becomes expensive, when it becomes tight, when the US government starts to crowd out other borrowers, that can really go and seize up economic activity. And that is a concern.
David, gold and Bitcoin reacting quite strongly to all of this. Give us the rundown.
Yeah, so this is kind of counterintuitive because they don't offer a yield, but they are hard assets or digital assets as well. And we saw Bitcoin last night ever so briefly when it hit record highs. Gold has been on an absolute tear this year. And so investors are looking at what's going on when it comes to the fiscal side of the equation. They're looking at what's going on at the US bond market. And they're saying, well, hang on, something's going to have to go and give at some point. And so they're rushing to hard assets. And hard assets that in the past, particularly when it comes to gold, have a proven track record. And it's no really surprise. Those two assets at the moment are definitely buy on dips because there's clear concern out there about the trajectory of what's going on with the rates markets right now.
David, jumping ahead and perhaps back to Japan for a minute, is Japan's situation similar or different forces are currently at play, do you think?
Well, Japan's got a couple of factors. Some of it is a fiscal equation. Some of it has got a massive debt loading. It's got its debt to GDP ratio just for the government is about 250% of GDP, give or take a few percentage points either side. It's huge. It's unprecedented across the Western world. And then you've got a government that's trying to go and spur inflationary pressures, a central bank that's trying to spur inflationary pressures. And the bond market's woken up and say, well, we agree with you now. And their back end of their curve is really starting to go and ramp up. Yields are rattling very, very high. Indeed, I think what the 40-year yield and 30-year yields are already sitting at record highs. Now, that's problematic because you've got very, very low growth, and Japan has had a lot of problems trying to go and spur inflation. So you're talking about borrowing costs are going to be becoming more expensive. And the other side of the equation is that even at the short end of the Japanese curve, what's happening is that you're seeing borrowing costs are going up. And that's problematic for what's called carry trades because you go and borrow cheaply in yen, you invest in other currencies to go and buy high yielding assets. If the cost to borrow there becomes higher, then all of a sudden that starts to pressure that trade. It could lead to a big unwind in other asset classes.
David, just one more thing before I let you go. Could we see a so-called bond tantrum before anything changes and we move ahead?
Look, mate, the fact that we're probably talking about this now is a warning sign that potentially we might be nearing at least a near-term top. But when you look at the structural forces that are driving this, they are unlikely to be changed anytime soon. The US is trying to go and add more to its spending profile when it comes to the US government jet projection. So when you look at what's potentially going to come down the pipe, yes, there is a risk that it could go and take place. I wouldn't say it's a guarantee at this point by any stretch, but the longer this persists, if they're going to ignore the bond market will bite, and I promise you it will bite hard.
Yeah, well said by you, and I want to thank you for joining us on the program. As always, a pleasure to speak to you today. Thanks for the rundown.
Always great to be here. Take care.